Welcome to the Sustainability in Motion podcast, brought to you by ED4S. We focus on the fast-moving sustainability world to help listeners better understand the sustainability and environmental challenges facing the business community. I'm Matt Orsagh, Chief Content Officer at ED4S.
Hello, Matt. Happy to be with you. I'm Nawar Alsaadi, CEO and founder of Kanata Advisor and the Chief Advisor to ED4S.
Thanks for joining us today, Nawar. Today, we're going to discuss how investors use and can use sustainability data. For this episode, we'll use a quasi-interview format. Well, I'll be interviewing Nawar, but I'll chime in if I have anything interesting to say, and hopefully I do. So let's get started. Nawar, there's a lot of talk about financial material sustainability or ESG data that's financially material. Do we have a good definition of what that means for investors?
That's a good place to start, Matt. But I'll probably go even further by first asking the question of what is financial data? What does financial data actually reflect when we look at an income statement or a balance sheet at the revenue item or a net income line item? What this information is basically, it is a reflection of every factor that impacts a company. And when I say every factor, that could be technological factor, could be economic, could be social, could be environmental, could be business and competitive factors and regulatory and governance. So financial data is really an attempt to distill all of that into a number or a series of numbers. And since these numbers tie back to certain factors that are either environmental or social or governance related, that means there are clear linkages between financial data and ESG data. So what is financially material in that sense is any ESG data point that ultimately has a material impact on the financial line items that investors look at, and that could be revenue, could be expenses, could be net income. That's one way to kind of simplify that definition of what is financially material. The only thing I would add here is that what is financially material from an ESG standpoint really depends on the industry that the company operates in. So what is financially material for a transportation company or a technology company or a retailer in terms of ESG data can differ materially. So if you are, for example, an airline, the price of fuel, your exposure to sustainable fuel, the efficiency of your engines, all that has implications on the cost of running your airline. And if you are a technology company, anything related to data and data privacy and protecting your clients from data breaches, that has also financial implications and business implications. So in that context, digital information is more financially material, and so on and so forth.
Yeah, and I'll back things up a little even further. And the definition of what materiality is going to differ somewhat from country to country, but it's generally very similar. You know, the definition in Canada may be slightly different than the definition the regulator has in the United States and so forth. But it's generally meant to be, or, you know, I think of, I'm in the US and I think of the SEC definition of material data that has come from case law. And it's generally thought to be any information that an informed investor would think is important to know in order to make an investment decision. And that's a general definition, but that's going to be the case in most markets. And to back up a little further, how we got here to considering material ESG data is, you know, I started in this industry of looking at ESG data, mostly from the G point of view, over 20 years ago. Not to date myself too much, but it was right around the year 2000. And I was with a firm, it was called Governance Metrics International, that's now part of MSCI. And we were looking at hundreds of pieces of data, most of them on corporate governance, because investors were just starting to realize and just starting to put corporate governance type data into their investment process. And we were tracking a little bit of S data and a little bit of G social, or a little bit of E, a little bit of environment, a little bit of social, but not very much. And then around 2005, the UN started the UNPRI, which wanted to codify looking at ESG data and having a framework for incorporating ESG data into the investment process. And that's how this all started. And then over the past decades, we've been arguing over, investors have been arguing over with companies about what is and what is not material. And your definition of materiality, captures that very well. It's going to be different for companies in different industries. It's going to be different across times. It's going to be different in many factors. It's going to be different depending on what the investor's time frame is as well. So a follow-up question I'm going to ask is, how do investors use that financially material sustainability data in the investment process today? We've gone through a little bit of history about how we got here, but what do you see is best practice today? How are people using this?
Yeah, thanks for that additional color, Matt. I think it is helpful to provide that background on how we got here in terms of materiality, and you're spot on by citing the SEC definition around what would a reasonable investor care about when looking at data related to companies. And staying in that spirit and looking at investors and how they use sustainability information, I've been reflecting on that question for some time. I'll be presenting on that specific topic with the IFRS Sustainability Symposium. And the question is, how do investors use sustainability data in the investment process? And I ended up comparing the process to cooks, the way a cook would use food ingredients to make food. This is to say there are just an infinite ways of how investors would use sustainability data in the investment process. You can use sustainability data on product development. You can use it in security selection. You can use it in portfolio construction. You can use it in risk management. And under all these kind of buckets, there are multiple other branches. So when we talk about product development, you might be thinking about using that data to identify which company is best in class. Maybe you want to be more thematic and focus on environmental, social issues. When you are building a portfolio, you might be using that data to think about your asset allocation and diversification. In terms of security selection, you probably be looking at, depending on your investment strategy, whether it's fundamental or quant driven, you'd probably be looking at factors that you would include in that process, that fundamental or quant process, to drive your investment strategy, which in most cases here is focused on returns, unless you want to add impact as another factor where it becomes another dimension of it. So I would say you ask about best practices. I do believe we are still in the early innings of what would be a best practice on how that information is used. And we really have to be very careful when we talk about best practice, because if you are looking for returns, then your best practice is probably different from somebody looking to drive impact. There might be some cross-pollination between the two. You might be looking, for example, in all cases, best practice would be having transparency around how you're using that information. Best practice is using probably different sources of information because ESG data is still maturing. The quality could be questionable in certain cases. And obviously communicating the outcomes or the impacts of the use of that data on your desired outcome. So these are some of the best practices that, just kind of thinking out loud, as I think about this question.
Yeah. And I'll add one that I've come across myself. And it's not one that I thought of, but I've come across many companies that do this, many businesses that do something similar, is developing a materiality matrix or materiality map. And that's, from investors, I'll walk through it both ways, but from an investor's point of view, you could be a huge global investment bank with thousands of employees, or you could be a small shop with a couple of employees, and you have to understand how are you going to be able to track and analyze what's material to you. And so you sit down and discuss, internally, what do we think? What's our formula? What's our recipe, to stick with the cooking theme? What's our recipe for materiality? And you may have a different recipe than I do, and large firm A may have a different recipe than large firm B. But whether you're an investor or a company, you should, before you start making the meal, you should have a recipe that you're operating from. And a materiality matrix is simply sitting down and whether you cover all sectors or certain sectors, understand what are the material issues in that sector or across the economy. And these are the ones we're going to focus on. You have, and again, just like to torture further this cooking analogy, there are thousands of ingredients out there, but you're not going to use all of them. There's thousands of data points that you have the option of saying are material or not material, but your investment firm or your company should decide which ones are material either for your investment process or for your business before you get started. So that is kind of setting the table, again, torturing this cooking metaphor. Can you provide us with an example or examples of financial material data that investors can use in the investment process?
I think one area I'd like to touch on is social data. We obviously talk a lot about environmental data. You mentioned governance earlier, Matt. I think the social piece of it is obviously critically important. And here I will cite a couple of studies. One was a meta study by Gallup that looked at 456 employee engagement research studies covering 54 industries, 2.7 million employees, and close to 100 countries. And they concluded in that study, or at least in that overview of the academic literature, that companies that positively engage their employees have 18% higher sales. They are 23% more profitable. They have 10% more customer loyalty. They have 28% less theft or shrinkage within their operations, 64% less safety incidents, and 41% less quality defects. So this is a very powerful data point to think about when we think about information that is relevant for investors, because obviously these data points I mentioned ultimately flow back to the balance sheet, to the income statement, and drive valuations if you have higher sales or better profitability. And to kind of support that conclusion, Wharton, CPP Investment, and FCLT Global did a study between 2010 and 2021 looking at close to 3,000 companies. And again, they looked at employee engagement, and they found out that companies that engage positively with their employees have 1.2% higher return on invested capital within 12 months of initiating a program of employee engagement, and 4% higher return on invested capital over a 3-year period. For those who are listening to us who may not know what employee engagement is, it's really a series of initiatives to be respectful of employees, to give them a fair economic contribution for their work, to have a level of diversity and psychological safety in the workplace. It's really about valuing your employees, not just in words, but in action. So to me, that's the kind of information that can flow back into a fundamental or quant investment process. And, we can dive into that in a bit, Matt, but to me, that would be an ideal example of information that investors should be and are interested in.
Yeah, that's a great summary, and one that I think of that comes up. And again, I'm in the United States, so I'll mention one that I've heard about very often is in the retail space. People are familiar with like Walmart and Target and Costco, for example. They're big, retailers in the United States. And Costco is famous for investing more in their employees, paying a higher wage for their employees, and some of the things you talked about. And we have a big family. We have 4 kids, and we shop at all of these. And I've noticed, looking around the stores, you can notice those things. And investors, know those things, and they may value the Costco way of doing things over the Walmart way of doing things, over the Target way of doing things, or vice versa. But it's a very interesting and important piece of input data. And I'll add to that there's a big push for more information on the S, because, as you said, the G and the E have gotten a lot of publicity. But for example, here in the United States, the only S data that companies are required to publish in their reports to the SEC is number of employees. And of course, there's tons more S information that investors would want to get their hands on. And so there's a big push for more S data so people can better understand what is the training, what's the wage and labor relations and those kind of things. So you're absolutely right. I mean, and that's just one industry I talked about. This is going to be similar depending on what industry you're talking about. All right, well, enough of me talking. We'll move on. Can you walk us through maybe the process of how a fundamental or quant investor would incorporate this ESG data in their investment process?
I think that's maybe a good opportunity to pause briefly and talk about what fundamental investors are and what quant investors are. And again, go back to our cooking analogy. I would compare fundamental investors to traditional cooks. Fundamental investors are looking at age-old recipes. In the way they prepare their dishes, they understand that if they follow certain steps, if they choose a certain type of ingredient, if they respect tradition, ultimately they're going to produce a delicious dish in terms of whatever they're trying to cook. But fundamental investors use both qualitative and quantitative data. So there is a bit of a gut feel as well when it comes to fundamental investors. They don't just robotically looking at specific numerical factors. They're talking to management teams. They're talking to employees. They are reading different media news articles and talking to other investors and trying to understand whether a company is exceptional in a way that the financial data is not reflecting or is in the process of becoming exceptional. And that approach has implication on how they use sustainability data. Now, if you look at quant investors are a bit like molecular gastronomists. They're really kind of distilling the art of investing down to its constituent kind of factors. They are looking at the chemistry and physics of how the food is prepared. A lot of it is very empirical, is very academic. Quant investors are running models and algorithms. They're really trying to exclude the human factor from decision making. So they look for data that is applicable to large set of companies because they don't have the luxury in taking that deep dive and deep conversations with management teams and other stakeholders. So they look at tens of thousands of companies, and they're looking at ESG data points that could help shed light on some of these questions we discussed, whether they're environmental or social, but again, in a numerical, repeatable, credible way. So to go back now to the study that I mentioned, or the couple of studies about employee engagement, a fundamental investor would start this process by, obviously, you want to start this process, or any investor is trying to understand ahead of that transformation, which company is potentially becoming better. That's the way where you could generate the most alpha, by basically trying to figure out where the ball is going, and then you go stand there to catch it. Now, it doesn't mean that the historical data is not helpful. That could still help you understand where that company was, but investors are always looking for clues of where things are going. So if you are a fundamental investor, you're going to speak to the management team, you're going to speak to the employees, you're going to compare pay levels at that company or companies you're looking at, you're going to look at the turnover rate, you're going to look at the diversity, equity, inclusion initiatives. You may speak to some of these employees, you may assess yourself the quality of these diversity initiatives, you may look at the educational capacity building and training that these employees are offered. This is quite different from what a quant investor would do. A quant investor is not going to speak to management team. A quant investor is going to look at these data points I just mentioned around employee engagement, and they will try to convert them into what we could call an employee engagement factor. And that factor may have a series of descriptors. So they will try to look at specific metrics like turnover rate, employee stock ownership percentages, average pay, maybe just the diversity tables, how many men or women or minorities are at a specific company. They may also look at alternative data sets. They may look at LinkedIn and they look at the employee composition in a certain way and they tie it back to the companies in their portfolios. So that would be really the starting point for these two camps. And once they have kind of established a process around figuring out which companies have proper engagement or potentially well positioned to move in that direction, because maybe the real-time data is signaling that direction. We mentioned LinkedIn, maybe a lot of minority or female executive are getting promoted. That could potentially send a message that this company is moving in a different direction. Then they would start to distill their investment universe. If you're a fundamental investor, obviously, you're also looking at other set of factors. But what happens is that once you distill down your universe, let's say you're a fundamental investor, you're looking at 50 companies, you distill it down to 20, great potential investments. The level of employee engagement or your determination of that level may sway you to favor 5 or 10 of these companies over the other companies in that basket. A quant investor would want to test that factor they created along with the descriptors I mentioned. They probably want to run algorithms and back test and to see, well, if this company had a decreasing turnover rate over 6 months or 1 year or 2 years, if they had higher employee pay, if they had more equity awards to their employees, they would probably track these patterns, and they see what happened to the stock price, what happened to that company vis-a-vis other companies in the same sector, and they will try to make a determination whether there is an opportunity to capture a return. And then finally, I will just end up with this. Once you kind of go through this process as a fundamental investor or as a quant investor, you're going to ultimately take a decision on what you're going to do. So if you are a fundamental investor and you finally you kind of distill it down to a number of companies that you think have good employee engagement or probably are moving in that direction, you may adjust your DCF model, your discount cash flow model. You may reduce that discount a little bit. That will up the value of the company in your model or reduce its risk. You may also, as a fundamental investor, decide to take a position in a company that is not engaging well with its employees and engage with that company, because you've concluded that they're not doing proper engagement, and that becomes a catalyst to unlock value in that company. If you are a quant investor, once you've kind of tested or back tested the factor you created, you will probably go through a new series of tests. So assuming the factor is valid, that let's say turnover rate does lead to a higher stock price in 12 months or 24 months, you may include that factor into a multi-factor model that is taking in consideration other factors, the value of the company, the momentum around the stock price, the growth, and so on, and see whether it improves the predictability of that model. If it doesn't really change much, you may decide not to include it. You may include it if it's neutral and you still want to favor companies that are engaging. But you may as well just construct a whole portfolio, focus on employee engagement, and based on that sole factor, which is employee engagement, or maybe you'll put it in a social kind of basket and sell it as a product, focus on the social side of ESG. So it was a bit of a lengthy walkthrough, but that's really the process distilled on how you could turn an academic paper into something actionable that is going to generate alpha.
Thanks, Nawar. I think that's a very thorough explanation that I hope is helpful to our listeners. So let's switch gears a little bit. And we've talked about financial material data to generate better investment returns. But something that people are starting to think more and more about in the ESG side of things is impact investing. How does this incorporating ESG data fit into impact investing?
I would say fundamentally the process is very similar. The only difference that there is that you may include data points in that process that I described that are not tied to alpha generation. They might be neutral. You might be including, I just kind of alluded to that briefly when I talked about quant investors. If quant investors test a social engagement factor in their portfolio and they notice that it's neutral to returns, but it is orienting their portfolio toward companies that have better employee engagement, they may very well include it and use that flavor to argue that this fund is contributing to employee engagement in the sense that it's favoring companies that are engaging with their employees, and hopefully that direction of capital has benefits for that company. So it's creating additionality through lowering their cost of capital or so on. If you're a fundamental investor, you may look at some of that data, and then you decide to really follow the second action I mentioned, which is, well, there are some companies I'd like to invest in, but some of these companies are behind in terms of employee engagement, so I can create impact by engaging with them. So that becomes an impact investment. There's major difficulty. I mean, generally, there's a difficulty in driving impact through public markets because unlike private markets, you usually have less impact as an investor. You are part of a really large pool of investors. So I would say the practicing impact in public markets generally is harder. But to answer specifically your question is that it's the only difference, and I go back to what I started, the only difference with financially material data and impact is that impact data is not necessarily generating better returns. The trick is, would you include impact data if it were to distract from returns, if it was to reduce returns? Investors don't want to see that. And if you were to do that trade-off, then you need to be very explicit that you're going to include data that is going to favor a specific set of companies on social or environmental factors or what have you, and you're doing it knowing that that may lead to maybe less attractive returns.
Yeah, that leads well into the last question I want to touch on is, in impact, you have to ask yourself up front, whatever the you is, it could be an individual, it could be a foundation, it could be a large investment firm. What are the goals you're trying to achieve with that impact? Is it purely a financial goal, but you think you could have an impact on something, or are they equal, or does the impact take precedence over financial returns, or any combination of those? But something that is really in the investment zeitgeist now is ESG and anti-ESG movements against ESG, and some of that comes from the dismissal of the materiality test that we often see in using ESG data. Where I come from an investor side of things, ESG was always at the service of, is it material or not? But in impact, that's not necessarily the case. And I think there's often confusion about how ESG isn't used. So can you speak a little bit about what we're seeing in the backlash to ESG these days?
I think, Matt, I think the impact of anti-ESG is, it might be unusual to say this, but I think it's generally positive. It's positive in the sense that it's really weeding out the pretenders in this field.
No, I would agree.
If you don't have a thorough process, a transparent process to integrate ESG data and the investment process to generate returns, yet you're claiming that you're doing that to generate returns, then I think those who are skeptical of ESG have a case to argue that they don't want these factors to be integrated. Now, having said that, as we mentioned earlier, when it came to impact, and you just reiterated that point, Matt, if you are transparent around the trade-off, if there are between impact and ESG, then we don't really have any issue because it's a free market and investors can allocate capital wherever they want. They can rationally choose to have less financial returns because they want societal returns or environmental returns. So the anti-ESG movement has that nucleus of truth. But the problem is because of a lot of the anti-ESG rhetoric is political, people who are kind of behind that anti-ESG bandwagon are not interested in that nuance. It's all black and white. They don't want ESG to be included in any capacity in the investment process. Yet, despite how we started this conversation, financial information is a reflection, in part, of non-financial ESG data points. So if you are going to exclude this data, you are going to ultimately impact investment returns in a negative way. But when it comes to a political argument, rationality goes out the door. So I do think there is a bit of that will continue with us just because there are people who build now their career against woke capitalism and ESG. But what is happening, and if you look at a paper that was published in August last year by the Confidence Board, the nonprofit kind of organization, they published a research on how companies, including financial institutions, are responding to the anti-ESG movement. And they've concluded that over 60% of them are deepening the linkages between value creation and sustainability, exactly to push back against that accusation that they're doing this for ideological reasons. So at the end of the day, the anti-ESG movement is making sure that ESG is here to stay, and it's here to stay for the right reasons. And the greenwashers and the ones who are not supposed to be in this space are probably the ones who will leave it because of the anti-ESG movement.
No, that's a great summary. And one thing I was thinking of while we were talking was, we're speaking in the beginning of 2024, and I was reading recently that more people will vote in elections this year than any year in human history. It's about half of the population of Earth is voting on leadership this year. The biggest democracy in the world, India, is one of those. And so it will be interesting to see how ESG and anti-ESG rhetoric ramps up this year and maybe dies down after that happens. But we'll have to wait and see.
All right. Thanks, Matt. It was a good conversation.
Well, thanks for the conversation, Nawar. I hope this was helpful to our listeners. That concludes our episode. Thanks, everyone, for listening. And again, feel free to reach out to us and let us know topics you think we should discuss and any other feedback you have. Thanks, and take care.